All right, welcome back. Tonight, warning signs for the economy. New data showing higher prices could be on the way for U.S. consumers after wholesale prices jumped much higher than expected for producers and manufacturers in July. The latest producer price index, which measures the average change in prices paid to producers, jumped almost a whole percentage point. Economists are expected a rise of just 0.2%. The report showing that Trump's tariffs are pushing costs higher. Fresh vegetables saw a 39% monthly price surge, which is the largest spike in over 3 years. Out front with me now, Jim Bianco, longtime Fed watcher, president of Bianco Research, which provides investment analysis. Thanks for being here, Jim. What does this report mean for the prices that we'll be seeing at stores in the coming months?
Unfortunately, I think it means that we're going to see higher prices. Now, we're not going to see anything like 2022 with the massive spike up, but we're going to see them continue to move higher. The overall consumer inflation rate is around 3%. This number, the producer price number that we saw, is a little over 3%. And I think we're going to continue to see that trend up.
Despite the new numbers and what you just laid out very clearly, President Trump today saw only good news. And the way he put it is the inflation nightmare is over. Let me play this for you.
And now our inflation is down to a perfect number, a beautiful number, hardly any at all.
Jim, what do you say to that?
It's not. I mean, unfortunately, it is still a number that is very high. The Federal Reserve has a target of 2% on inflation. It's 3%. Now, that doesn't sound like a lot. We haven't been at 2% in 5 years. And indeed, the business website says that about 35 to 40% of Americans are not getting raises of more than 3%. So, and those usually are on the lower end of the income spectrum. So they're not keeping up with the inflation rate. Now, it is better than it was a couple of years ago. A couple of years ago, it was way worse. But relative to where we were, say, pre-pandemic, it is still a very elevated number and a troublesome number.
What does this all then mean for the Fed's decision next month to cut interest rates or not? And, well, let's be frank, the unrelenting pressure campaign that the president has been putting on Fed Chairman Jerome Powell.
Well, it looks like they're going to cut interest rates at the September meeting, and it looks like that the market is expecting it. But this number is a real complication for that because the Fed has been holding off all year saying, we're worried about inflation. We're not going to raise rates. President Trump has been criticizing them. Then we get inflation, and then they say, now we're going to cut rates. And so Chairman Powell speaks at a conference in Jackson Hole next week, one of the widely expected conferences of the year. He's got some explaining to do. Why this number, why it is now the appropriate time to cut interest rates when 2 or 3 months ago, when we actually did have much lower numbers before they started up, it wasn't.
How nightmare of a nightmare scenario is this all setting up for Jerome Powell now?
I mean, it's going to be a sticky number and it's going to be a difficult thing for him to kind of navigate through. But, you know, I like Jerome Powell and I think he'll be able to do it. But you know, this is one of these instances where you're going to earn your pay, and he's going to have to earn his pay here, trying to deal with this number, with the expectations of a rate cut, and either delivering it or explaining why he doesn't want to deliver it.
If they do cut rates, what do you expect to see then?
Well, that all depends on how the market wants to view it. Remember, a year ago, they cut interest rates. And a year ago, the market kind of concluded it wasn't the right policy. And long-term interest rates and mortgage rates went higher because it was rejecting that policy. That's the risk you face here. If you could cut rates anytime you want, but if the market doesn't agree, it will actually reject that policy and say you're creating more inflation. You're stimulating when we don't need stimulation. And I don't want to own long-term bonds and those yields go up and mortgage rates go up and borrowing costs go up. So that's the risk that we face with this right now. They could cut rates, but if the market doesn't agree, it could wind up being counterproductive, actually making long-term interest rates higher, not lower.
Jim, when it comes to kind of the trend that we have seen over time, but very specifically during this term, of if he doesn't like the number, he calls it rigged. If he doesn't like the July jobs numbers, he fires the head of BLS. You know, early on, as soon as he got into office, he said the good parts of the economy are mine, the bad parts of the economy, those are still Biden. Injecting this kind of doubt and uncertainty in the data that the United States, the U.S. collects, the numbers that are being put out, saying it's being done for political reasons. Are you seeing that having an impact?
Not yet. I think the market still believes in the integrity of the data, but the trend is in the wrong direction. And so while he might fire the head of the BLS and call the numbers rigged, I don't think they were rigged. I think a lot of people at the BLS and a lot of people in the markets don't think they're rigged. But the more we get of that, the more doubt that will come in. So we haven't crossed that Rubicon yet. Maybe yet is the key word, but we're headed kind of in that direction, and it is worrisome.
I was going to say, we're leaning hard on that yet. It's doing a lot of work tonight. It's good to see you, Jim. Thank you very much for your time, as always.